two people, same $10,000, same year. 28 years later, one has $160,000. The other has $11,000. No different investments, no different risks. Just two different understandings of how money actually grows. By the end of this video, you'll know exactly what separated them and which path your money is currently on. Most people think about money in terms of how much they save each month. But that's not actually how wealth gets built. Wealth gets built through multiplication, specifically to how many times your money doubles. And there's a 10-second formula that tells you exactly how fast that's happening. It's called the Rule of 72. And once you know it, you'll use it for the rest of your life. Here's how it works. Take the number 72 and divide it by your annual rate of return. The result tells you how many years it takes for your money to double. Let's run through some real numbers. If you're earning 1% per year, which is roughly what most savings accounts offer, you divide 72 by 1. That's 72 years, a full lifetime just to double your money once. If you're earning 6%, it's 72 divided by 6, 12 years. At 8%, it's 9 years. At 10%, which is roughly the historical average return of the stock market, it's about 7 years. Now, here's where it gets interesting. Let's say you invest $10,000 and earn that 10% consistently. At 10% per year, your money doubles roughly every 7 years. After 7 years, $20,000. After 14 years, $40,000. After 21 years, $80,000. After 28 years, $160,000. You didn't add a single extra dollar. Your money multiplied 16 times, just because you understood doubling time and let it run. That's the person from the beginning of this video who ended up with $160,000. The other person? Their money sat in a savings account at 1%. After 28 years, they have just over $13,000. Same starting point, same time. The only difference was the rate of return and the understanding of how compounding actually works. Now there's a catch. And this is the part most financial content glosses over. The rate of return your bank or broker shows you isn't always your real rate of return. Your real return is what's left after three things take their cut: fees, taxes, and inflation. If your investment earns 8%, but you're paying 2% in annual fees and inflation is running at 3%, your real return is only about 3%. At 3%, the rule of 72 says your money doubles every 24 years instead of 9. That's the difference between seeing your money double 3 or 4 times in your lifetime, or seeing it barely double once. So the first practical step is simple. Find out what you're actually earning, not the headline number, the number after fees, after inflation. Index funds, for example, often have fees as low as 0.03%. That's nearly nothing. Actively managed funds can charge 1% or more, which sounds small but costs you an entire doubling cycle over 30 years. Small numbers, compounded over time, become enormous differences. Here's the part nobody warns you about. Compounding feels like nothing is happening at first. You invest $5,000. After 3 years, you have maybe $60,000. It feels slow and pointless, and most people give up right here. But the growth doesn't move in a straight line. It curves. The last few doublings give you more money than all the early ones combined. You just have to stay in long enough to reach them. The people who pull out early don't lose because of bad luck. They lose because they misunderstood the shape of compounding. So that's truth number 1. Make sure your money is actually doubling at a meaningful rate. But knowing how fast it grows is only half the picture. The other half is understanding where it actually sits. Because right now, millions of people think they're protected when they're not. Let me tell you a quick story from the 1970s. There was a concept in investing called the Nifty 50. These were 50 blue-chip American companies, household names like Xerox, Kodak, Polaroid, Sears. Institutions and financial advisors said these companies were so dominant, so essential, that you didn't even need to check the price. Just buy and hold forever. People did exactly that. They poured money in. The prices climbed, and the rising prices became proof of quality, which brought in even more money. Then, in 1973, the economy shifted. Inflation spiked. A recession hit. And suddenly, those can't-lose companies had the furthest to fall because they were the most expensive. Polaroid dropped 91% from peak to trough. Avon fell 86%. Xerox fell 71%. These weren't speculative startups. These were the safest, most respected companies in America. People who bought at the peak in 1972 waited 25 years just to break even, not counting inflation. A quarter century of zero real returns on the safest investments available. Here's the pattern that caused it. Too much money had quietly concentrated into too few companies. When things looked good, nobody noticed the concentration. When things turned, everyone felt it at once. Now, why does a story from 1973 matter in 2026? Because the same pattern is playing out right now, and most people don't realize they're inside it. If you own an S&P 500 index fund, the investment most financial advisors recommend, you might assume your money is spread across 500 companies. And technically it is. But here's the reality. The S&P 500 is weighted by market size. The bigger the company, the more of your money goes into it automatically. And as of early 2026, roughly 30% of a standard S&P 500 index fund is concentrated in just 7 companies. 7 out of 500. Now those are genuinely powerful companies, but so were Polaroid and Kodak in 1972. What matters isn't whether they're good businesses today. What matters is whether they're priced for perfection, and whether your retirement is entirely dependent on them staying that way. The word diversification is supposed to mean your money is spread across many things that don't all move together. But when 30% of your portfolio tracks 7 stocks, you're not as diversified as you think. So what's the practical response? Here are 4 calm, straightforward steps. Nothing extreme, nothing complicated. Step 1. Check your actual exposure. Go look at the top 10 holdings in any index fund you own. Most brokerages show this on the fund's overview page. Out of the percentages, if the top 10 holdings make up more than 25 or 30% of the fund, you have meaningful concentration, more than most people realize. This takes 5 minutes. Do it this week. Step 2. Consider adding balance. You don't need to sell everything, but you can deliberately add investments that aren't as concentrated in the same handful of companies. Equal weight index funds, for example, give every company in the index the same allocation regardless of size. International funds give you exposure to markets in Europe, Japan, and elsewhere, which are currently trading at much lower valuations relative to their earnings than US stocks. Small and mid-cap funds give you access to companies that have historically performed well over long periods, but haven't been the center of recent market enthusiasm. None of this is exotic. It's just building a more balanced foundation. Step 3. Minimize friction. The rule of 72 showed us how powerfully small differences in return compound over time. The flip side is equally true. Small fees and inefficiencies compound into major losses. Choose low-cost funds. Use tax-advantaged accounts like IRAs and 401k cess wherever possible. Avoid frequent trading, which generates taxes and erodes returns. Every percentage point you stop giving away extends your doubling speed. Step 4. Build a cash buffer. This one is underrated. The reason people make their worst financial decisions isn't greed, it's desperation. When markets drop and people have no cash cushion, they're forced to sell at exactly the wrong time. If you have 6 to 12 months of expenses accessible in a high-yield savings account, you can sit through a market downturn without being forced out. You can be patient. You can even buy more when prices are lower. The people who built wealth through market crashes weren't necessarily smarter. They just weren't desperate. So here's where both truths connect. Truth number 1, your money grows through doubling, not just saving. The rule of 72 tells you exactly how fast. If your real return, after fees and inflation, is below 5%, that's fixable. And now you know how. Truth number 2, growth means nothing if your money is quietly concentrated in the same handful of companies. Real diversification means owning things that don't all fall together, not even 6-2 swing fire rolls. You to become a full-time investor. They just require awareness and a few deliberate decisions. The person who ends up with $160,000 instead of $11,000 didn't do anything exotic. They simply understood these 2 things and didn't panic when things got uncomfortable. The best time to understand this was 10 years ago. The second best time is right now. Check your real rate of return. Check your concentration. Build a buffer. Then give your money the time it needs to do what compounding does best. Grow slowly, then all at once. If this helped, a like or subscribe helps more people find it. Thanks for watching. See you in the next one.